Hello class, welcome to our lecture on Chapter 3. In this chapter we're going to learn how to measure the economy. Specifically, we're going to learn about gross domestic product and economic growth. We're going to begin looking at a simple model called the circular flow. This simple model shows the connections between different sectors of the economy. At first, we're simply going to look at households and firms. So this simple model shows the flows of goods and services and also the factors of production. This is what's used to make goods and services. We're going to show how those flows relate and go between the firms and the households. So the reason why we're learning the circular flow is that it gives us a good idea of how national income or gross domestic product is calculated. So in the circular flow diagram, we're going to have two sectors, as I mentioned, households and firms. Now the factors of production are land, labor, capital, and enterprise. If you think of it, any of the factors of production, so the inputs to producing any good or service, can all be categorized into these four different categories. So land is a general term for anything, including land, but also natural resources. And of course, labor effort is used to make goods and services. So when we're thinking of labor, we're thinking of the skills, the effort. You could have unskilled labor, skilled labor. We're thinking of all of that human capital that's used to produce goods and services. Capital, when we speak of capital here, we're speaking of actual physical capital, like tools, machinery, plants. We're not talking about financial capital, like money invested in stocks. Because when you buy a stock, that's just a transfer of ownership. There's actually no production that is associated with that. An exception would be if you purchase a stock through your broker. Well, the service that the broker provides would be considered as part of GDP, but that would be considered as a service, not actual capital. So capital is just physical capital. And then enterprise is the labor that is a more specialized form of labor that's related to the effort put into organizing the factors of production. So this relates to the owner of a firm. And it's important to point out that all factors of production are owned by the households, and firms are also owned by the households. Okay, so let's look at the circular flow of income. So again, we have our two sectors, firms and households. Consider the product market and the factor market. So the product market relates to goods, the goods and services that are produced. The factor market, we're thinking of the factors of production, the market for, say, for example, labor. Households provide firms with the factors of production. As I said earlier, they're owned by the households. So households own labor, land, capital, and enterprise, and households provide that to the firms. And what do the firms do with it? Well, they make goods and services. Okay, so this flow here is of the physical production. So we call this the production flow, and this is just telling us about how the exchange that's going on between the households and firms. So households provide all of the things necessary to produce goods and services to the firms, and the firms use that to make these goods and services. Let's look at financial flows. So in terms of financial flows, what do firms give households? Well, firms provide households with income, of course. So the households are providing these factors of production, and in return, they get paid for that provision. So if we think of land, the payment for land is rent, the payment for labor is wages, capital is interest, and enterprise is profit. So the firms, there's a financial flow from firms to households here in the bottom. Now, what do households provide firms in terms of a financial payment? Well, of course, households spend their money on those goods and services. So you have a flow of money going from households to firms, which we call consumption expenditures. So in the product market, we have goods and services being exchanged for money. Okay? In the factor market, we have the factors of production like land, labor, capital, and enterprise. Those are provided to the firms, and in return, the firms provide income to the factors of production, which are owned by the households. Rent here is income received for the use of any natural resource. Wages is the income received for labor services. Income received for the use of capital, and profit is whatever's left over. And that you can think of as a reward for the enterprising effort of the firm owner. And also the firm owner has to take risk in setting up the business. At these financial flows. So now we're just going to focus on the financial flows. So in our simple model right now, this is a closed loop. So flows of payments are continuous, and so the aggregate income and output can be measured at any point by sort of metering the flow anywhere in this circuit. Or you can think of this as like a water hose, and there's a certain pressure in the hose, and we can think of the pressure as the amount of spending in the economy. If that pressure were to increase, we could think of economic growth, or if it decreases, we can think of economic contraction. So at this point, there's no leakages here or anything. We'll talk about that in a moment. An important thing to glean from this is the fact that total expenditures, upper red arrow, so that's how much households spend, and that comes from the income they get from firms. So we can see here in this closed loop that total expenditures will always equal total income. Okay, and also it will also equal the total value of production. Every buy and sell transaction here is income to one sector and spending to the other. So when households spend money on a good or service from a firm, that on the other side of that transaction is income to the firm. Okay? The bottom line is we can clearly see that income is equal to expenditures. And we'll also talk about that it's also equal to the total value of production. Let's look at an illustrative example to reinforce these ideas. So let's imagine a very simple economy. There's only 3 people and they each own businesses. Bill owns and operates a bakery. Annie is the proprietor of a natural soap making business, and Tammy has a tailor shop. Within this, only a single $10 bill, which is currently in the possession of Bill the baker. So now suppose that Annie makes some soap and Bill buys it with the $10 bill. Then the $10 bill on jeans from Tammy, and then now Tammy has the $10 bill and she buys $10 worth of bread from Bill. Then, what is the total value of production? Well, they change each for $10, so of course it's $30. What's the total income? Well, each of them received a $10 bill for the production they did, and so the total income is $30. What is total spending? Of course, you guessed it, it's also $30. So noteworthy to point out that all of this was financed by a single $10 bill. So if you're actually thinking of the money supply in the economy, the total amount of money isn't equal to the total value of production or any of these 3 items here. So this, points out or makes it clear that a stock and flow are not the same thing. Economy described that we just looked at clearly demonstrates that the value of total production is equal to total expenditure and total income. True, or is it just a coincidence? Well, we'll look at that in more detail in a moment. But one thing you should realize is that a large part of macroeconomics is looking at the link between these 3 aggregates: production, expenditures, and income. Reinforce why these 3 things are equivalent. So let's first recognize that the market value of goods and services produced must equal the total amount that buyers spend to purchase them. So the total production is equal to total expenditure. Also, let's, have picked up on something here. What if some of the goods are not sold? Well, we treat these as if the firm purchased them from itself, because what they're really doing is accumulating it in inventory. And so we say that that's an unplanned inventory. We'll talk a little bit more about that later in the course. So clearly you have a bunch of firms in the economy, they produce stuff, and so the total expenditure should equal total production. If some of it they weren't able to spend, if some of their production wasn't purchased, we think of the firm purchasing it by themselves, for themselves, in the terms of investment in inventory. So learn in a few moments that we can use these identities that we're talking about to measure gross domestic product in different ways. And so we'll talk about that in a moment. Now, it's also one point we have total production equals total expenditure. But we can also, expenditures are equal to what the firms receive. So the amount a firm receives is equal to the total generated by production, and those are all of the payments to the factors of production: wages, interest, rent, etc. We'll talk about government in a moment. At this point, we don't have government in our model, but anyways, at this point, we can think of all of the income that we talked about before. That's all going to, that's all equal to income. So the bottom line is the total expenditures also equals total income. So therefore we have all three equal. Total production equals total income and equals total expenditure. This actually is sometimes a mental identity of national income accounting. So up till now, it was a closed loop, as I mentioned earlier. So what that means is there's no leakages, right? There's no way in our simple model, for example, for people to save some of their income. So let's be more realistic now, and we're going to add different things to our circular flow model. So we're going to add leakages or withdrawals from the circular flow. You can think of the water pressure as being reduced because of there's some kind of a leakage in that circular flow. So not all of the income that the households get will flow from them directly to businesses. The circular flow shows that some part of the household income will be put aside for savings. So in our more advanced model of the circular flow, we will incorporate savings, which is a leakage. We will also, and the leakage associated with the government is taxation. And we will also sector, and here the leakage associated with the foreign sector would be imports, right? We're spending money in another country. So there, you could think of a flow of income leaving the country. Now, actions into the circular flow. So when we think about savings, well, savings can be used to provide funds for businesses to invest. Okay, so the corresponding injection to the leakage of savings is investment expenditure. The government, although they collect taxes out of leakage, they also can spend money. So government expenditures is an injection into the circular flow. And if we think of the foreign sector, the corresponding injection would be when people in other countries buy from us. So that's a flow of income into the country. So exports we consider an injection. Okay, the bottom line, as we'll see, is that an economy is in equilibrium when the rate of injections is equal to the rate of withdrawals. We can think of it, if we think of the circular flow, we can think of that water pressure going around analogy. If it's an equilibrium, there's no change in the pressure. When the pressure is changing, then the economy is not in equilibrium. So let's go back to this is the circular flow that we've looked at up to this point. We just have the two sectors, and it's a closed loop. There's no leakages or injections. But now let's add savings. So savings, of course, is the portion of income that's not spent on consumption. It's an important source of loanable funds, and the amount depends primarily on the level of incomes in the overall economy. So Just some quick identities here, or formulas. So income, of course, is equal to what you consume plus what you save. So you can only do two things with your income. You can either consume it or save it. And obviously then savings is your income minus your consumption. And so if this is negative, then you would likely had to borrow. Okay, so in terms of our circular flow, we're going to add another sector here called a financial intermediary. Okay, a financial intermediary takes savings from households and they provide businesses for investments. So we have our leakage here and our injection here of investment. So of course, if the amount of savings is equal to investment, then we don't equilibrium. But if, say for example, investment exceeds savings, then that's possible to happen. Then that would be we would have a situation where the injection is greater than the leakage, and so we can think of that water pressure analogy. We can think of the pressure as increasing, okay? But that's not going to go on forever, because the increase will mean that there's more income, and then people will save more. So it will increase at a decreasing rate and then eventually level off to a new equilibrium. Now let's add the foreign. Okay, so we have our foreign sector here. The leakage here would be, and the injection would be exports. So now if the sum of the leakages, so if the sum of savings plus if the sum of savings plus imports is equal to the sum of exports and investment, then we would also again be in equilibrium. Now we're going to add government. So it charges taxes to its citizens. So the leakage here is taxes. Taxes can come from households and businesses. Okay. Now the government, although they take taxes from households, they also give some of that money right back in the form of transfer payments. So this TP here is referring to transfer payments. So just think about it. The government collects taxes from a lot of people, but then it also gives some of that directly back to some of the households in the form of pension payments or welfare or social assistance, unemployment insurance. So what we're really interested here is the net tax that the government is collecting from households overall. The government also collects taxes from businesses, and the corresponding injection then is government spending. So this is our full model, that the circular flow. Now we have 5 sectors. So we have businesses, households, and then we added financial intermediaries, we added government, and the foreign sector. We have the full model. So we have our leakages, our injections. So the corresponding injection to this leakage of savings. So here we see action that's related to the leakage of savings. We have government spending, net taxes, and imports. So here are the leakages and injections. This is the overall model. So let's talk is essentially a state of balance or equality between opposing forces. So you have some kind of a system. We're thinking about any kind of system. If it's in equilibrium, it's stable. There's no tendency for it to change. So in this setup, the national equilibrium is where we have total leakages are equal to total injections. So the sum of the leakages of the injections. So we can have a different amount for savings and investment, imports and exports. The bottom line is all 3 of these have to add up to each other. If the injections are greater than leakages, we can think of the pressure of the water in the circular flow as increasing, and so the economy would expand. And then as it gets bigger, it would actually slow down, because as income increases, so does the amount of savings, imports, and taxes. So it's going to, increase and then slow down and settle at a new higher level. If leakages are greater than the other way around, the economy would slow down, so income would fall. But as income's falling, the amount of leakages would also be falling. So with less income, people are going to be paying less taxes, saving less, and importing less. So when we have that the economy is growing, and in other words, the injections are greater than leakages, we can think of that as economic growth. If we have leakages greater than injections, we can think of the economy as contracting, and if it's large enough, we would think of a recession. And that causes the total injections to be the total leakages, then we would have economic growth. And again, as I said, the higher level of income to continue to rise until the resulting increases in the savings, imports, and taxes were enough to create a new equilibrium. So it will level off. So this is just a summary diagram. Think of this sort of scale here. We have our withdrawals, we have our injections. If these two things are equal, then this thing will balance out and we will be in equilibrium. Okay, so gross domestic product is simply the value of all final goods and services produced in a period, a certain time period. So we could think of a quarter of a year, a full year. So essentially it's a measure of the value of production. So you can think of maybe like an Excel spreadsheet, and the first column you have the name of the good or service in the economy, or you have in that column you would have a list of all of the goods and services produced in the economy for a particular time period. And then in the next column you could have their prices, and in the next column you would have their quantities. And then if you multiply all the price and quantities and then sum up that entire column, you would get the gross domestic product. We could also look at gross domestic income. That would be the total earnings received by all households, businesses, and government in a certain period. So we usually look at the gross domestic product measure. This isn't something we look at a lot. So the most common one, and the one you'll hear on the news a lot, is gross domestic product. So the value of output is determined by the getting something into the hands of the consumers and is equal to the amount that consumers have paid for it. So in equilibrium then, we will say that the gross domestic product, which is the value of production, is equal to aggregate expenditures, which is also equal to income. So again, this is what we've already talked about before, those three things that are equal to each other. Production, expenditures, and income. We just have some different notation here. So gross domestic product is, as we say up here, it's the total value of all final goods and services produced in a period. So that's the total production. So that's what gross domestic product is. And aggregate expenditures is the amount spent, and income is denoted by Y. So since things being equivalent, for example, the expenditures is equal to incomes in an economy, well then we could estimate gross domestic product or measure it two different ways. We can measure it with the expenditures approach. With this approach, we are looking at the expenditure side of the national income accounts, and we're going to be adding up the total spending on final goods and services produced. Investment. Again, this includes spending on capital goods. We're not talking about financial investments here. This also includes increases in firms' inventory for unsold goods and residential investment, example, construction of new homes. Then we have government spending. So this is expenditures for a currently produced good or service. And we have net exports. So aggregate expenditures can be represented by the formula here. It's equal to consumption, investment. Now there's a little G here, that's investment. So when we're talking about investment, we're talking about all the money spent in a particular time period on things like tools, capital equipment, construction of new homes. We're not going to subtract off depreciation because we're interested in how much is produced. And it's possible that some of that investment in capital was to reduce or to make up for depreciating capital, but we're not going to subtract that off here. So that's why we have this little G here for gross investment. Then we add our government expenditures on goods and services, and then we have our net exports. So net exports is the difference between how much we bought from the net exports is the difference between what other countries have purchased from us minus from them. So it's equal to exports. So that's what people in other countries have bought from us minus what we've bought from other countries, and that's imports. So let's look at 2018. We have some figures here for the different expenditure items. So consumption expenditure was 1.2 trillion. Gross business investment was 494 billion. Inventory investment was $11 billion. Government expenditures was 508 billion. We have our exports, we have our imports, and so we could add these up and get our total GDP. Now remember, inventory investment is part of this, so these two items here are both included in the I. So we just have our C plus I's, two I's here, we just sum them together, plus G, plus exports, and then subtract imports. Now this statistical discrepancy is basically the difference between the two approaches. So one way to look at, so we have to remember that we can't get this information perfectly. Statistics Canada has very clever ways of estimating the amounts in this table, but it's not 100% perfect. It's really good. They do a very good job at estimating it, but there are little statistical discrepancies. So the actual value for the statistical discrepancy is just the difference between the income approach and expenditure approach. We're going to look at the income approach in a moment, but it's just the difference between the two, and then you divide it by 2 and then add the higher one to the lower estimate, and then the other way around. So using this table, the GDP to be $2.2 trillion. So we're adding the consumption, investment, government spending, net exports, and then we're just adding this statistical discrepancy. Now let's look at the income approach. So again, we could also get at what product is by adding up all of the incomes in the economy. So we need to look at some categories here. The compensation of employees. So this is going to include their gross wages, salaries, commission, etc. We're also going to add in gross operating profits of corporations. And remember, we don't want to subtract off depreciation, so this is before depreciation and taxes. And then gross mixed income is just profits from corporations are incorporated, right? They have limited liability. There are many companies who are not corporations. That's what this category here is for. So we're going to add the profits of non-incorporated businesses and also partnerships. So you can have this would be sole proprietorships and also partnerships. And again, we're going to be looking at this before depreciation and taxes. And then we're also going to add in net of subsidies on production. So a lot of this would be things like property taxes. Now, if we're thinking of income taxes, well, we don't need to separately add that because we're not taking it out here. So here we're thinking of the, your gross amount on your paycheck, not the amount after taxes. So this is going to include all of the taxes that you would pay to the government in the form of income taxes. But there are other taxes like property taxes. We need to add those in. And then also things like sales tax, like HST, we want to also add that in because that's not going to be shown, that's not going to be in here anywhere. We need to look at the incomes to households, businesses, and then also the government, okay? And so the government takes in sales tax, so we want to add that as well. But we also have this term here, net of subsidy. So what does that mean? Well, the government most of the time taxes, but it can also, for certain situations, maybe there's a certain firm that's producing a healthy product and they want to subsidize them. So that's the negative of a tax. So we want the total amount, the net amount that the government received. So we're going to take in we're going to add the taxes that they've collected and then subtract off any money that they provided in the form of subsidies. So here is some data for Canada. Here are the different income items. So if we were to add them together, compensation of employees, gross operating surplus, gross mixed income, these are the incomes to corporations. Again, these are all gross. Then we have in Canada, the taxes less as subsidies on production was 99 billion. And then here we had taxes less subsidies on products and imports. So this is the sales taxes. That turned out to be $145 billion. And the statistical discrepancy, here we have the same 694 figure as before, but here it's negative. Okay, and so this means that if you multiply 694 times 2, that will give you the difference between the two estimates, the income and expenditure approach. So we've divided that in half and subtracted this from the one that turned out to be higher and then added it to the other one that turned out to be lower. And so in this case, when we add everything up, including that statistical discrepancy, we get the $2.2 trillion that we had before with the expenditure approach. Okay, so that's the two different ways that we can get it of gross domestic product. So we can get it by adding up all of the expenditures in the economy or adding up all of the incomes in the economy. And if you remember at the beginning of the lecture with the circular flow, we had a really good discussion there about why we would expect these two things to be equal. So up till now, we've talked about, but the figure that we have so far isn't very useful in measuring how economic activity changes over time, or whether we could compare countries' gross domestic product. So up till now, we've just thought about GDP as being price of the goods times the quantities, and then you sum that up. But there's an issue. So let's think about an example. Suppose GDP was 1 billion and 1.35 billion in the first and second year respectively. So we have 2 years. The first year it was 1.25, second year it was 1.35. Can we say that economic activity increased by that difference, by that increase of 0.05 billion between this period? Well, let's think about it. When we calculate GDP, we're looking at end quantities in each of the years, right? So in the year 1, when we multiplied the prices and quantities together and took the sum, we got 1.25. In the second year, when we multiplied the prices and quantities together, we got 1.35. Well, over this period, both the prices and the quantities can change. So if we're interested in just economic activity, then we're interested only in how the quantities changed. We don't want prices changing as well. So the answer here is no, because both prices and quantities can change over time. So we could have had this number increase just because of prices. So we could have produced exactly the same thing in these two, but the prices were higher in the second period, and that's why our GDP figure is higher. So we would be incorrect by saying that the production or the economic activity has increased. And so just to note, one of the most important aspects of gross domestic product, or usefulness of it, is that it's a measure of economic activity. And of course, many people, economists, anyone in the financial sector, are interested in gauging the economic activity in an economy. So gross domestic product is a measure of economic activity, and so it's a very important economic indicator. but we can't just look at two figures over time without making some adjustments to the prices. So when we make adjustments for prices or hold prices, that measure would be called real GDP. So real GDP would hold prices constant in some specific year, and so the differences in real GDP will reflect only changes in quantities. And that's what we want. We want it to reflect changes in economic activity or production. So nominal GDP is what we've been looking at up till now, essentially. It's the market value of the final production of goods and services within a country in a given period using that year's prices. Sometimes we refer to that as the current prices. And again, this is what we've been calculating so far. Real GDP, on the other hand, changes in prices. So it's calculated using prices from a selected base year. So we pick a year. There could be some reason for picking a certain year over the other. We pick a year and then we calculate GDP using only those prices. So we're holding prices constant in a base year. And so the value of GDP that we'll get, the differences in it, will reflect only quantity changes. Okay, so real GDP holds price constant over time so that changes in its value reflect changes in economic activity. Okay, let's look at a numerical example. So consider the economy of student land. So obviously a hypothetical example. In student land, there are 4 products: coffee, bottled water, photocopies, and pizza. This is data for 2018, and we're just going to select that as the base year. So in this year, these are the quantities that were produced of the 4 goods. These are the prices. And so if we multiply these and then sum it up, we will get that nominal GDP was $761.25 here. Okay, let's ignore the real GDP for a sec. Now, in 2019, we have data again. These are the quantities, these are the prices. So if we multiply these together and take the sum, we will get nominal GDP is $883.50. 2020, we have our data for 2020. Again, if we multiply the prices and quantities and take the sum, we will get that nominal GDP is 1,201.25. Now, if we compare just these nominal GDP figures and say that, you know, this is economic growth or this is relating to increases in economic activity, we would be wrong, because as you can see, the prices are not the same in every year. So not only are the quantities changing in each year, so are the prices. So what real GDP does is it's constant the prices in a base year, and then we just recalculate those prices. So in the base year, the nominal and real GDP will be the same, because these are the base year prices we're going to use throughout. And of course, the nominal and real are going to be the same then, because we're going to be multiplying the quantities and prices together. But if you look at the next year, 2019, we're going to calculate real GDP by just using these quantities and multiplying them by the base year prices. So we're going to be taking this column and taking the sum. If we do that, we get that real GDP is 818. So we can see here that the price the differences in prices resulted in the nominal GDP being higher than this amount, not only due to the quantities but also the prices. If we just hold the prices constant in the base year and just see how much the GDP increases because of the different quantities, we see that it's actually 818. So it did increase, right? There was more economic activity, but it's less than what just comparing the two nominal figures would suggest. Again, in 2020, if we do the same thing, so here we're going to take these quantities, multiply them by these prices, take the sum, and we will get the real GDP, which is 1,008.75. So again, it's less than this because prices also increased between these 2 years. So this series of real GDP figures, we can compare over time and say that the changes in them are due to changes in economic activity. If we draw these on a graph, we can visualize the difference between the two. So in the base year, nominal GDP and real GDP are the same at 761.25. If we look at the nominal GDP series, we see that it's increasing here. And so this was nominal GDP in 2019. This is nominal GDP in 2020. But if we were to look at this and say that that is how economic activity is changing, we would be overstating it. The real GDP figure holds prices constant in 2018, and so this increase depicted in this line is due just to quantity changes, which is what we want. Here's another example for you to look over for your notes when you're studying and see if you can see the similarities between this example and the last example. But it's essentially the same thing. The tables are a little different, but the bottom line is for real GDP, you are holding prices constant in a particular base year. In this case, the base year is year. So you can see the prices for year one are actually reproduced here, so that in each of these cases, for real GDP, you're just multiplying the quantities times year one prices. Okay, let's talk about economic growth. So economic growth basically refers to an ability to produce. Okay, so let's talk about the economy's ability or capacity to produce goods and services. To see if an economy is growing, we need to know if it did actually produce more goods and services. So in other words, we want to use our real GDP measure, which eliminates the effects of price changes, and then real GDP per capita. To measure economic growth, we simply calculate the percentage change in either of those two figures, or those two measures. A percentage change is simply taking the current value minus the previous value, dividing value, and then multiplying that by 100. So for example, if we were talking about the price of a can of Coke, so let's say the can of Coke today is $3, yesterday it was $2. In terms of a percent, how much did it increase? Well, we take the current value, which is the 3, minus the 2, which was yesterday's value. That gives us 1, and then we divide it by yesterday's value, which was 2, and we get 1/2. 1/2 times 100 would give us 50, so it's 50%. So something increasing from 2 to 3, that's a 50% increase. So we do the same sort of idea, but with our real GDP. Here is an example. So suppose that real GDP in the first year is 150 and real GDP in the second year is 200. Then the economic growth would be calculated by just calculating a percentage change of these two figures. So how much higher is 200 compared to 150? Well, it's the difference, which is 50, divided by what it was before, 150, and then we multiply that by 100, and in this case it would be 33%. Now this isn't the most realistic example. Most developed countries grow between 1 and 3% per year. 4% growth in a particular year would be considered very good. So that's how you calculate growth in terms of just real GDP. But another interesting measure would be to divide real GDP by the population. So then you get an estimate of sort of how much of the economic pie everyone has on average. And so we could just take real GDP and divide it by the population, and then that would give us real GDP per capita. And then to find growth in real GDP per capita, we just take the percentage change as we did here, but we're going to be using real GDP per capita instead. So let's test our understanding on this. So the economy of Rustica produces only two products, carrots. In 2012, it produced 5 million kilos of carrots and 2,000 tractors. 2013, it produced carrots in the amount of 6 million, so it increased by 1 million, and it increased its production of tractors by 200. If the price of carrots increased from 2 to 250 per kilo, and tractors, the price increased by 2,000, calculate the value of nominal and real GDP using 2012 as the base year. So this is our data in the table format. So now if we want to calculate nominal GDP in each of the 2 years, we simply multiply these and then take the sum. Multiply these, take the sum. Okay, so nominal GDP in 2012 is 110 billion. So we've just multiplied 5 times 2 and then added to that 2,000 times 5,000, 50,000. Now how do we get real GDP? Well, when we calculate real GDP, it's the base year. So it's actually going to be equal to the nominal GDP. It's the same thing, because we are holding prices constant in the year 2012, and this is year 2012, so they're going to be the same. Now for 2013, the nominal GDP is 129.4 million, and that's obtained just by multiplying, adding them together. But now how do we get real GDP in this year? Well, to do that, we hold prices constant in 2012, so we're essentially just going to be using these prices and the 2013 quantities to get real GDP. So we're going to multiply 2 times 6, and then we're going to add to that 50,000 times 2,200. And then we will end up getting $122 million. Some of the benefits of economic growth, well, of course, it could lead to better, improved quality and length of education, better transport, more support for all arts and cultures, a better protection of the environment, protection of human rights, democratic involvement. There's many, many benefits of economic growth. Of course, you know, the standard of living is going to be higher. People are going to be able to consume more goods and services. What are some of the sources of economic growth? Well, the two main sources are labor productivity, and so labor productivity is simply just the output per period divided by the units of labor. So it's just basically output per person over some time period. So the overall average in the economy. If you think maybe about 150 years ago, the amount of people that would work in agriculture was quite high. Perhaps it was something like 40 or 50%. And so just the output from agriculture alone used a lot of the resources in an economy. But now only about 3% of people are employed in agriculture, and we have more food than we know what to do with. This is because of productivity. So productivity leads to more of an economic pie because we're using our labor resources more efficiently. So labor productivity is key to growth in the standard of living. It is what's behind the growth in real GDP per capita over time. And of course, human capital is related. I should also point out that the number of people in the economy too will enable you to be able to produce more goods and services. But if we're thinking of real GDP per capita or the standard of living, just having an increase in the number of people doesn't guarantee that the standard of living is going to increase. What is really important in terms of labor productivity, education and skills, and of course technology is important as well. So anything that enables us to make more stuff per person is obviously going to increase our real GDP per capita and hence our standard of living. So there's some obvious problems with the GDP measure. One important thing is that it doesn't include underground activities. So there's a lot of production that's done in the economy that's unreported. So obviously illegal activities, or unreported but legal activities. So these things aren't included in GDP. Also non-market activities. So there's again, a lot of production that is important that occurs, but it's not going to be in the GDP measure, like any home production. So anything that you produce around the home, that's obviously not going to be included in the GDP figure. Other things like volunteer services, again, are not going to be included in GDP. But if these things remain relatively stable over time, then if we're looking at the percentage change in GDP over time, then the measure of growth is going to be pretty valid. So just in terms of a summary, we looked at 4 different main topics here. We looked at the circular equilibrium. We looked at the concept of national income accounting. Basically, we looked at how to use the expenditure and income approach to estimate GDP. And we looked at some important measures of economic growth. That's it for today. Thank you for listening and have a great day. Bye for now.